A desperate builder seeks $25 million. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's have a look at this article from the Fin Review about home builder Simmons asking shareholders for $25.5 million, everyone. So home builder Simmons Group will go to shareholders seeking $25.5 million to boost its working capital and keep trading through difficult conditions that will not improve until 2024, the ASX-listed company said on Friday. And you know what? I'm just going to let's bring up the Simmons website. I probably should have thought about that before I started recording, but you know, it's the weekend. It's the weekend, guys. So we'll jump over here. You know, we'll click on their ad. And they're a spec home builder, guys. Let's have a look at some of their designs. We'll go Simmons Range. Oh, boy. I mean, there you go. Perfectly fine little spec homes. This is the sector that we've seen a lot of builders go under. We really have seen it. Let's have a look. The Armstrong. You know, come on. Okay, the plan's getting up. Nope. Anyway, I mean, nothing wrong with them, guys. The planning is simple. I mean, look at that robe. Whoa. Look at that walk-in. Oh, I can't see it anyway. Well, that bloody huge walk-in robe. That's insane. Anyway. Nothing wrong with it, guys. Shit, that's a lot of money spent there on that robe. 613 grand just for the house for a 4-bedder. Anyway, spec homes, guys. A spec home builder. So, you know, I'm not surprised. Would you buy some shares, guys? The country's 7th largest home builder will issue new shares at 12 cents to existing shareholders in a 13-for-9 pro-renounceable entitlement offer. That represents a 28.8% discount to the 30-day volume-weighted average price of 16.8 cents and a 4% discount on Thursday's closing price of 12.5 cents. But the company's second-largest shareholder said it would not take part in the offer, creating the likelihood that its 26.5% stake will be diluted to as little as 10.9% if founder and 45.7% shareholder Gary Simmons, who is underwriting the offer, increases his stake to a maximum 77.8%. Oh. Considering, I mean, you wouldn't be happy with this as a shareholder. It's diluting what you have, isn't it? But you'd rather that than the company go under. So, considering the challenging market conditions currently in Victoria, we have chosen not to participate in capital raising offers by the Simmons Group, Newcastle-based Next Building Group Chairman Ian Williams said. Simmons also said the third largest shareholder, FJP, an entity related to Melbourne developer Frank Palazzo, which has 13.8%, would not commit before the offer was announced. Simmons, which said earlier this month it was considering options for strengthening its balance sheet, announced the capital raising on Friday, saying it had expected trading conditions to improve by October, but they had not. Prolonged wet weather and flooding, supply shortages, delays in delivery of materials, labour shortages, higher borrowing costs, delays in land registration, and inflation meant little change for the better, it said. Simmons' so-called extra to schedule measures of additional costs on a build had historically been 1 to 2% of projects' costs, but was currently between 4 and 5% and was likely to remain that way for the near term, the company said. Prolonged adverse period. It would take until the 2024 financial year for the company to work its way through the substantial pipeline of contracts it signed before January this year, Simmons said. These were low-margin contracts that did not include sufficient risk premiums to absorb the subsequent cost increases. With the continued availability of the overdraft and borrowing facilities and net proceeds of the offer, Simmons will have a pro forma liquidity of at least $44.2 million to sustain it through what is expected to be a difficult, more prolonged adverse trading period. Chief Executive and Executive Chairman Wright Simmons said. That's telling that a large builder like this is worried that the conditions are going to remain in this mess pretty much until 2024 financial year. Little worrying, guys. Under the offer, Simmons will issue 212.7 million new shares, equal to 144%, more than double the number of shares currently on issue. Oh boy. Order Minute is lead manager, and Gilbert Tobin is the legal advisor of the offer. The offer opens on December 5 and closes on December 14. Contracts signed after January this year had higher gross margins, and another change from April gave the company more flexibility to raise the price it charges customers. And as these more profitable contracts increase in proportion, the company's profit margin would improve, Simmons said. At $323,000, the company's average site start value was 17% higher in the 3 months to September from $276,000 a year earlier, reflecting pricing improvements, it said. Simmons also published unaudited figures on Friday showing that even as revenue in the first quarter rose 16.4% to $199.5 million from the same period a year earlier, its gross profit margin fell to 16.6% from 22%. Simmons' EBITDA margin fell to a 0.9% loss from a 2.2% profit margin, and its net after-tax loss deepened to $5.8 million from $1 million. The tough conditions are affecting many builders. Earlier this month, Perth-based ABN Group, the country's fourth biggest home builder, which operates in WA and Victoria, said it swung to a $42.5 million after-tax loss from the year to June, its first from a $19 million net profit in 21. ABN experienced significant increases in the cost of delivering building works, including building materials, site labor expenses, construction delays, as well as higher salaries and wages, the company said. The company's commercial arm was also affected by the tougher conditions. COVID impacts of building inflation, material supply challenges, delays, and trade shortages drove significant cost escalation, it said. This was most acutely felt due to extended construction timeframes and low margins across ABN's commercial contracts. So there we go, everyone. Let's jump back and have a bit of a look more at some of Simmons' work. I mean, where's their smallest one? Their smallest one. What do we want? Price max, 300K. Is this it? The 19? Looks like it. $282,000. Can we explore? There you go. So you got, the porch entry. I mean, these are little spec homes, guys. There's nothing wrong with them. But even this is much more luxurious than you would have had back in the day. You wouldn't have had 1, 2, 3 bedrooms with a bathroom and a walk-in robe and an ensuite. These are luxuries. These are luxuries. Even a walk-in pantry is a luxury. So the houses are getting, they're getting bigger, everyone. And that's why part of the reason why they're getting more expensive as well. This is what frustrates me. It's just not the culture of getting a really small little 3-bedder, shared bathroom, tiny kitchen as a starter. It's just disappeared. Let's have a talk about this. So what's interesting is their concerns over, the market moving forward. I mean, as a shareholder of Simmons, you can't be happy with this much of a dilution of your shares. What do you reckon, guys? So what's next year going to say for the construction sector? This is certainly something to keep an eye on. It's just the ongoing construction apocalypse like I've been talking about. As always, thanks for watching. Check out HeiseBim and HeiseSays International for other topics that I discuss. And if you're a fan of the channel and want to support us, you can financially on YouTube or Patreon. Use our referral links, buy our pocket squares, or call us if you need an architect. Take care, everyone. Have a great day, and I'll see you in the next episodes of HeiseSays.